In this section, I will introduce the step 6, adjustments or adjusting entries. This is also the second journal entry in the accounting cycle. The first journal entry will be based on external transactions, and the adjusting journal entry will focus on the internal transaction, which are not as obvious as external transactions. When we prepare the trial balance, usually that's the last day of accounting cycle. The first 5 steps cover all the external transactions occurred during the accounting period. From step 6 to step 10, these are all on the last day of accounting cycle. What's adjusting entry? So these adjustments record the effect of internal events or transactions on accounting equation. And these adjustments are recorded at the end of each accounting period or accounting cycle. After adjustments, we can prepare financial statements. The objective of adjusting entry is to ensure that all revenues and expenses are recognized during the accounting cycle. The adjusting journal entry also reflect the spirit of accrual accounting. You will see that during my introduction. There are 3 types of adjusting journal entries. Here I only introduce 2. One is prepayments, the other is accruals. Estimate I will introduce later. And for each, we can also further classify it into prepaid expenses, deferred revenues, accrued liabilities, accrued receivables. So prepaid expense, the example I introduced in the prior journal entry, like this one. On July 1st, the company prepaid the rent for the whole year on the first day. So this is a prepaid rent. On this day, we recognize the $24,000 as an asset, prepaid rent. But when time lapse, for example, by the end of July, should we recognize 1 month's expense for this company? The answer is yes, because this company has used this leased assets for 1 month. That's the accrual accounting. The accrual accounting recognizes expenses based on the usage, not the cash flow. So here, the company paid $24,000, but $24,000 was the cash flow, but it was not the expense to be recognized. And deferred revenue is a prepayment from the customer. When the customer prepaid, the company does not recognize revenue, even it is a cash receipt from the customer. And this is recorded as deferred revenue, which is recorded as a liability. Here, prepaid expense is an asset, deferred revenue is a liability. The example is on this slide, July 16th. This $1,000 cash receipt was not recorded as revenue. Instead, it was recorded as deferred revenue on July 16 when the company received this payment from the jewelry store. We did record the cash inflow by debit cash $1,000, but we didn't recognize the revenue for this company. Instead, we recognize a liability. Why? Because this is prepayment from jewelry store. Make sense? Next, when time lapse, we are going to recognize the revenue which was deferred for this company. The prepayments, no matter cash inflow or cash outflow, cash is before the revenue recognition and expense recognition. That's why we call it prepayments. While accrue is different. We recognize revenue before the company receive cash, or we we recognize expense before the company pay the cash. So these are meaning of accruals. We recognize revenue for the company not when it receives cash, but when it provides service goods to their customers. We recognize expense for the company not when the company make payments. Instead, we recognize expense when the economic resources was consumed. Now let's start from the first one, prepayments. Prepayments occurs when the cash flow precedes either expense or revenue recognition, just like this. These two are all deferrals. It depends on the cash prepayments was paid by the company or paid by the customer. So prepaid expense is a prepayments by the company. We prepare financial statement for. For the deferred revenue, a prepayment from customer. So for the prepaid expense, it is an asset account. When the company makes prepayments, and the expense will recognize later. So for adjusting journal entry, we will recognize the expense, while we will credit the assets. Prepaid expenses. That's a typical adjustment for the prepaid expense. When the company make payments, it will recognize prepaid expense as an asset on its balance sheet. And there's a cash payment, we credit cash, right? Yeah, the adjusting journal entry follows the prior prepayments. Okay, so here we do not recognize expense, we only recognize cash outflow. And here we recognize expense. This is a consumption of the prepaid expense or asset. Okay, so here let me use the red circle. This is a adjusting journal entry for prepaid expense. Yeah, by doing so, the impact, we will debit expense, we will credit assets. This assets is prepaid expense. The impact on the financial statements, first, because we recognize expense, the expense will goes up. We assume the revenue does not change, so the income will reduce. On the balance sheet, we credit assets, so as assets goes down. Yeah. Also, because we recognize expense, so retained earnings reduce accordingly. These two are equivalent. Now let's take a look at this example. The company purchased $2,000 supply in July. And by the end of July, this is last day of accounting cycle, we find there are only $1,200 supply remain. That indicates the company used up $800 supply. See, this transaction, there's no external parties involved. So we need to identify this consumption, the reduction of the assets, and recognize the expense. So for the adjustments, we should debit expense. Here particularly, we debit supply expense, $800. Well, we credit the assets, supply, which is prepayments here by $800. So this journal entry made on July 31st. This is an adjustment. Originally, the company's supply balance was $2,000. After this adjustment, the balance is $1,200. It will be consistent with the physical value of the supply we find out. Also, additional $800 supply expense is recognized. If we do not or forget to make these adjustments, what happened? The ending balance of supply will stay as 2000, while there was no supply expense recognized. That means the balance sheet, the assets will be overstated, and expense will be understated, or the earnings will be overstated because the missing of these adjustments. Why we should make adjustments? Because accrual accounting focuses on the economic activities. During this month, the company indeed consumed $800 supply. We should recognize this consumption as expenses. So for the eternal transaction, it's kind of difficult to identify for new accounting students. So you need to accumulate experience. But in this textbook, we only introduce a few normal scenarios. And if you understand all of them, you have no problem in the tests. But in the future, during your career, you may encounter many different complicated scenarios. Another prepaid expense example. This one was a prepaid rent I just mentioned. The company paid $24,000 for the 1-year lease, but we didn't recognize lease expense. We only record $24,000 as prepaid rent, which is an asset. And 1 month after, we should recognize 1 month expense because 1 month has passed. The company used these assets, this property for 1 month. It should recognize this 1 month rent expense. So we debit rent expense. How we calculate? We just break down the $24,000 into 12 pieces evenly, each month $2,000. We debit this expense while we credit this prepaid rent, an asset. So after this journal entry, the balance of prepaid rent reduced to 22 because we credit 2,000, while we recognize $2,000 rent expense. Similar to the prior slide, which is reasonable, right? So this represents the left 11-month lease. And when time lapse in the future, every month the company will recognize $2,000 rent expense, while write down the book value prepaid rent by $2,000 each month. If we forget to do this, to make these adjustments, what happened? Prepaid rent will keep $24,000 balance, while rent expense is zero. But this doesn't make sense, right? The company used the assets. It should recognize the rent expense. It's not free. So that's the purpose of adjusting journal entry. For the adjustments, all adjustment will have impact on expenses and revenues. That's the purpose of adjusting journal entries. No adjusting entry, you will see cash accounts. No debit cash, no credit cash. No. If you see a cash account, either debit or credit, this journal entry is not a adjusting journal entry. Another example of the prepaid expense is long life assets. The company invests in a long life assets which can be used for multiple accounting periods, years, even decades. So the value of these assets is subject to depreciation. And usually the long life asset has a big value. We do not recognize the big expense when it was purchased. Instead, we will recognize depreciation expense in each accounting cycle based on the assumptions. So here, the company acquired a office equipment for $12,000, which was also purchased on July 1st. But we don't recognize $12,000 expense instantly on July 1st. Instead, we recognize an asset. So the depreciation, as I said, is based on the assumption. So if we assume the useful life is 5 years, that means 60 months. We only recognize depreciation expense for 1 month. Let's also assume these assets will be worthless at the end of the period after 5 years, so there's no value. So it is reasonable to evenly allocate $12,000 into 60 months. For each month, the depreciation expense is $200. Similar to the prior two example, we will debit expense and credit the assets. Office equipment is a prepaid expense and asset. We do not credit the office equipment directly. Instead, we credit the control accounts of office equipment. Let me explain why we do this. So you may think, okay, we just debit depreciation expense as part of our adjustments, $200, and credit office equipment. It has same impact on balance sheet and income statement, but we will lose some useful information. For example, if I show you the T accounts of office equipment, when it was purchased, we debit $12,000, right? After this adjustment, if we follow this way, we credit $200, so the book value will be $11,800. In the next accounting cycle, we will start from $11,800. The disadvantage of this method is we do not have the original cost of this asset. So to keep this information, we do not credit office equipment accounts. So we will keep the original equipment cost $12,000. While we create a control account, this is called accumulate depreciation. We credit $200. By doing so, the book value of these assets is a difference between this account and this account. Still $11,800. Right? But we have two information. One is the original cost. The depreciation will be accumulated to this account. You will see the net book value keep reducing because the accumulation here. That's the purpose. Basically, when we report the book value of these assets in the balance sheet, we will see three accounts. One is equipment, $12,000, and minus accumulate depreciation. I just use by the end of July, there will be negative 200. So the net book value of equipment will be 11,800. Instead of providing just one number, we provide three numbers: original cost, the accumulated depreciation, and the net book value. You will see lots of control accounts in the follow-up examples and in this book. The purpose are the same. Just keep original value and provide more useful information to the financial statement users.